Now, nobody will argue with me when I say rates are artificially low. They have to go up. I use the analogy of a yo-yo. You throw the yo-yo down all the way and it's going to bounce back up and it's going to go back into your hand. Anything that goes down too fast or up too fast will correct. So that's one of the main things that are going to be happening with interest rates. They're just too low right now. It's not sustainable. So they have to go back up. I gave you a more technical answer to these things, but that's really it. Hey, Rick Ullendorf here, loanwithrick.com, powered by Moving Mortgage. And in this video, we're going to go over the Federal Open Market Committee's statement. Yep, that's right, the Fed. They had a nice little statement today, a meeting, and I want to discuss what impact this is going to have on interest rates. So first and foremost, the Fed left rates unchanged. Now, what the Fed changes is the federal funds discount rate. I'll read what they said. They said the committee decided to keep the target rate for the federal funds rate at 0 to 1/4% and expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. Now that's a mouthful, but basically what they're saying is that we're not going to really do anything until we see some of the things we're projecting actually happen. So that's really the bank's overnight lending rate. It's going to affect more of the consumers, but it does put pressure on everything else, including mortgage rates, housing, and whatnot. So the second thing they said, which was that the Fed raised their inflation forecast from 2.4% to 3.4%. Now remember, their target rate's 2% per year, right? Now they already had the inflation forecast at 2.4%, and they raised that to 3.4%. Now, why is this significant? It's significant because inflation is the arch enemy of mortgage bonds, okay, of bonds and mortgage interest rates. When we have inflation, that puts pressure on interest rates. Interest rates are higher in an inflationary environment. And where are we right now? We're in a non-inflationary environment right now. Interest rates are super low. Obviously, we had a lot of other factors happening, but that's pretty much the soup and nuts to it. High inflation, high mortgage interest rates. So them actually saying that not only are they saying more than what they had expected, they're going even higher on their forecast up to 3.4%. That is very substantial, and the markets did not think nicely of that. In fact, they are down almost 50 basis points from when pricing came out today, and we are starting on what I feel is a landslide on mortgage-backed security pricing, which is going to lead to increased interest rates. The other thing they said was that employment is expected to come down to 4.5%. Now, currently, the national unemployment rate is 6.1%. Now, think of it this way. The more people that have jobs, the more people buy stuff, which is inflationary, right? So unemployment is a massive factor in where mortgage rates are heading and what's going to happen with housing. Now, the last thing they said, well, they've said a lot more than just these four things, but this is one of the main things I gathered here. The Fed is going to maintain asset purchases of $120 billion per month. Now, if you didn't know this, the Federal Reserve is a massive buyer of U.S. Treasury securities and mortgage-backed securities, which directly impact mortgage interest rates. Now, what they said was, and I quote, he says that the agency, they will continue to increase its holdings of both Treasury securities at $80 billion a month and agency mortgage-backed securities at least $40 billion a month until substantial further progress has been made towards the committee's maximum employment. There's that employment again, and price stability goals. There's inflation. Okay, so this is a big deal. If the Fed stops buying, which they will in the near future, guess what happens? You just lost your major buyer of mortgage-backed securities. And when you don't have a buyer, when you don't have that demand, when you don't have demand on something, guess what happens to the price? Price goes down. And if the price goes down on a mortgage bond, the yield goes up. Interest rates will go up. So that's what we have to look forward to once the Fed starts tapering their purchase of mortgage-backed securities. Well, I hope you like this content. If you do like it, please go ahead and give me a thumbs up, subscribe to the channel, and please do, if you feel so inclined, to pop me a like. It does help me out a lot. And I will see you on the next video. Thanks. Have a great day.